The efficient market hypothesis. Have you ever wondered if it's possible to consistently beat the stock market, or why some professional investors struggle to outperform simple index funds? In this video, I'll help break it down for you, what it means, its strengths, its weaknesses, and what it means for your future investments. This is a theory that suggests you cannot beat the stock market. Chapter 1. What is the efficient market hypothesis? The efficient market hypothesis, or EMH as it is commonly referred to, is a cornerstone of modern financial theory. It was developed in the 1960s by this guy. His name is Eugene Fama. But what's the basic idea? The idea is that asset prices reflect all available information. This means that if markets are efficient, it is impossible to beat the market consistently because any new information is immediately priced in. Whoa. If you're thinking to yourself, market efficient, priced in, what does all that mean? Don't worry about that, I got you. When economists say that markets are efficient, what they really mean is that the market has a high degree of publicly relevant information. Imagine a big playground where all the kids trade baseball cards. In this playground, everyone knows everything about every card, how rare it is, how good the player is, and what cool powers it has. Now, if you try to trade your ordinary card for a super rare one, no one would do it because they all know the true value of each card. That's kind of like an efficient market, where everyone has all the information, so it's hard to get a really good deal or trick someone into a bad trade. But what does priced in mean now? Priced in just means that the information is already reflected in the asset's price. This means that if everyone knows that a certain baseball card is the rarest, it will also be the most valuable. Chapter 2. 3 forms of market efficiency. There are 3 different strengths of market efficiency. We have weak form efficiency, a semi-strong form efficiency, and a strong form efficiency. The weak efficiency suggests that only past stock prices and volume data have no predictive power for future prices. So, technical analysis, for example, like reading charts and trends, won't give you an edge. The semi-strong efficiency argues that all publicly available information, like earnings reports, news articles, and economic data, is already priced in. Fundamental analysis would not help either. Which leaves us with strong efficiency. The most extreme version. It claims even insider information is already reflected in stock prices. However, in reality, this is debatable because insider trading scandals do exist. Chapter 3. Evidence. Let's look at why many economists believe the efficient market hypothesis has some truth to it. First piece of evidence. Index funds versus actively managed funds. If we look at this graph right here, we can see that the majority of actively managed funds almost never outperformed index funds. For those of you who don't know, index funds aim to match the performance of a specific market index by passively tracking it, while active funds are managed by professionals who try to outperform the market through stock selection and timing. Often index funds have lower fees, while managed funds have higher costs and risks, but sometimes, and definitely not always, have higher returns. Second piece of evidence. Random walk theory. The random walk theory suggests that changes in asset prices are completely random. This means that stock prices move unpredictably so that past prices cannot be used to accurately predict future prices. Third piece of evidence. The flow of information. Think about it. In today's digital age, news spreads in seconds. By the time you hear about a big company merger or new product launch, thousands of algorithms and traders have already acted on it. Chapter 4. Criticism. Does that mean my dream of becoming a profitable trader is over? No. Remember, it's just a hypothesis. Hypotheses are not objectively true, at least not unless they are proven to be. The major flaw in the EMH are market bubbles and crashes. If markets are so efficient, why do we see bubbles like the dot-com bubble or crashes like 2008? Behavioral finance suggests that human emotions like fear and greed drive irrational decisions. Another reason why it can't be entirely true is because of people like Warren Buffett or Jim Simmons. Both of them have beefed in the market for decades and became billionaires because of it. Third and most important critic point is algorithmic trading. In today's world, hedge funds use advanced algorithms to find inefficiencies. Inefficiencies that hedge funds use to make money. So, are markets really efficient? Or are they efficient for most people but exploitable by few? Chapter 5. What does that mean for you? First off, focus on the long game. If you believe the markets are efficient, trying to time the market or pick the next hot stock isn't just risky, it's like gambling in Vegas, but without the free drinks. Instead, the smarter move is to invest in broad-based index funds. They're simple, cost-effective, and historically, they've outperformed most active investors over the long run. Next.
Diversification.
Spreading your investments across different sectors, industries, and asset classes, like stocks, bonds, or even real estate, reduces your overall risk. Because if one sector tanks, others might keep you afloat. Think of it as building a portfolio that's ready for anything. And finally, cut the fees and keep your gains. Here's the part that most people ignore, but is critical: fees. Actively managed funds love to charge you high fees, sometimes over 1% of your portfolio, just for them to underperform. That's money straight out of your pocket. Index funds, they charge as little as 0.3%, meaning more of your money stays invested, compounding and working for you, instead of funding some manager's next yacht. So, let's simplify this. If you believe in the efficient market hypothesis, your game plan is simple. Think long-term, diversify, and stop wasting money on fees. It's not flashy, it's not sexy, but it works. And remember, the markets may be efficient, but that doesn't mean you can't make them work for you. So to sum up, the efficient market hypothesis challenges the idea that anyone can consistently beat the market. While it's not perfect, it does suggest that for most investors, keeping it simple with index funds and the long-term strategy is the way to go. What do you think? Do you believe markets are truly efficient, or do you think there's a way to beat them? And if you enjoyed this video, don't forget to like, subscribe, and hit the notification bell for more videos like this.